Can you see me? Okay, are we good to go? Good evening, friends, and welcome to this maiden topic and very interesting one that too on how to pick multi-bagger stock ideas. I'm Vinit Bulinchka and I'm here to guide you through this presentation, and I hope that it will be rewarding for you. But first, I wanted to give a shout out to uh, everyone for attending this webinar. Thank you very much. And especially to Dilip Bhai and the Surat gang, Jai Shri Krishna, the entire student community who's watching this program, and from for investors from all over the world who have queued up to uh, enrich their lives from looking at this program that I've created called How to Identify Multi-Bagger Stocks. But before we go on, a little bit brief about me so that you know that you're not dealing with some random cookie on the street. And currently, I am head of research with a premier broking firm. I have over 20 years of work ex in the stock markets. I love to teach. That is one of my primary goals now for the future. And I love multi-baggers. And more than that, I want everyone, each and every Indian and foreign person to be rich. So before we go to seeing what are the characteristics of multi-bagger stocks, I want you to know one thing very important, that there is no one formula to identify multi-bagger stocks. Since most important thing to remember is finding multi-baggers is not very easy. It involves an analysis of multiple factors which are key to identifying multi-baggers. We'll be looking at them shortly. But more the number of these key factors present, greater is the probability of success. However, there is a caveat. The presence of a large number of key factors still does not guarantee that you have got a multi-bagger stock. Another very important aspect which is absolutely essential is patience. To hold the stock for 5 to 10 years is a must. There is no standard time. People keep asking me, give me a stock tip which will go up 40% in 3 months. It's not possible. Stocks have their own tendency to move. They lag for 80% of the time, and they do make the entire move in 20% of the time. Another thing you have to remember is that just because a stock is cheap does not mean that it will be a multi-bagger. There's a tendency for people to go and buy low cap, low value penny stocks in the hope that they will generate multi-bagger returns. But I think you should learn your lessons from the fact that large multi-cap companies like Facebook, Google, Amazon, Solar Industries in India, which we had a coverage recently, have all moved up despite the fact that they were not penny stocks. Another thing which I want you to remember is that multi-baggers are not forever. You have to accept failure, and if a stock is not moving, you have to move on to the next idea. Another thing is, never bank on only one stock for it to turn out to be a multi-bagger. That is political suicide. Always have a basket of 5 to 10 stocks with potential, and remember, do not over leverage. Start small. It is a serious and full-time activity. It is a long-term process, and ability and experience in analyzing stocks is paramount. So if you do not have ability and experience, then you getting a multi-bagger purely a stroke of luck. And luck, to my mind, is where opportunity and preparation come together. So, and it is 80% effort and 20% timing. So we have to up our skills on the ability to analyze stocks, and that is the way to go forward. Secondly, you need to have a high risk appetite. You should have a mental flexibility, open mindedness, and ability to deal with corrections with patience are important characteristics as an investor. Now let's look at the 20 factors for 20x returns. Well, Google talks of 10x stocks. Here, as a jocular way, I put it at 20x. Actually, it's not essential that you get 20x, but even if you get 3 to 5x, what's the harm? So these are the 20 characteristics which are very important. The first and foremost is the man backing the business or the promoters. If you have a great promoter, half the battle is run because you are dependent on them to run the business. And a classic example of a good promoter is a Godrej Group. So we have three companies in the fold, which is Godrej Industries, Godrej Properties, and Godrej Consumer, and all three of these stocks have really performed to become multi-baggers. Then another important thing is that there should not be too much of leverage, or the debt level should be fairly reasonable. So I have deliberately chosen the idea of Godrej Consumer here to present to you because in the multinational FMCG business, most of the businesses are debt free. But here, Godrej Consumers, which is aspiring to be a global player, it has got debt on its book and it has used it very wisely. And their debt levels have hovered between zero point 0.4 and zero point 0.6. So it's not very unreasonable to have debt, but it should be a moderate quantity. And you need to have a unique business model, which is like an economic moat. Here, I would like to talk to you about an international company in the pharma space or genetics, which is called Orgenetics. Now, the beauty of this company is that it's a CRAMS company, which is doing research in contract research manufacturing in genetics. And normally in the pharma industry, what happens is that the innovator drug company which files the patent gets the bulk of the profits, whereas the CRAMS guys earn minuscule amounts. But here, going forward, this company is absolutely unique because they not only managed to do the innovator research, but for genetic information, the innovator company, let us say the client of Orgenetics is Pfizer, will need to be dependent on Orgenesis for taking the sample from him and finding the optimum human solution. Then another factor which is very important is business opportunity, scalability, and sustainability. Take the case of Maruti. You know, India is a fast growing company for the automobile industry. It has got the lowest penetration, highest population, and hence very apt for high growth of the automobiles. We have seen how the roads are crowded. So this is where the business opportunity lies. Secondly, there is scale, and they have been able to sustain this growth through very innovative strategies. Then another factor to look at is the nature of the business, whether it's cyclical or non-cyclical. So Tata Steel, which is the leader in the cyclical space, does extremely well when when the cycle is turning up. So you need to see whether the business is cyclical or non-cyclical, and if the business is cyclical, how is this company placed in relation to the natural cycle of the underlying commodity. And all of us are absolutely attuned to brands. We all want to buy branded stuff, and hence a great brand and great brand recall are paramount for the success of a business. So let us take Tata Motors. When they took over JLR was a very fledgling business, hardly had numbers in thousands. Okay, but the brand was huge. It had a global appeal and was very high recall on that too. So Tata Motors took in this brand, scaled the business, and today it has grown to become a multi-million unit business. Also, past performance of a stock is also very important. You know, just relying on future business is not is enough. You need to have a credible past performance to know whether when the opportunity arises, can the stock do well. And here is an example of Solar Industries. For the last 10 years, this company has grown at 25% CAGR, not only on top line, but also on bottom line. And while it was doing this, the opening up of the Indian sector for defense, global opportunities, and where Coal India has been asked to double its production, what is happening is this company, which is 5 times the size of its peers, is aptly placed to grow its business. So not only is past performance a good indicator of how high growth the company will do, but we need to track it on good quarterly performance also. And you have to understand that high growth is a requisite for finding a multi-bagger stock. So you cannot have 2-3 quarters of high growth, 3 quarters of pedestrian growth. The growth has to be extremely consistent. Take the case of Imami. Ever since the stock listed on the exchange, it has grown by in leap and bounds, not only on revenue, but the profits have grown at a faster rate than the revenue growth. Another stock which offers huge opportunities for becoming a high growth stock is Talwalkar, which has a very high EPS, and a very low PE multiple. So this is an extremely sweet spot kind of position for a stock to do well, and we believe that Talwalkar is positioned accordingly. So not only is high growth an essential characteristic for multi-baggers, you also need to provide high return on equity and capital employed. An example is Serra Sanitary where it has consistently delivered high ROE and high ROCEs. Capex outlay is one indicator which can point to the direction whether the stock will be a multi-bagger or not. For example, if a company is operating at peak utilizations, then how will it grow if it does not have adequate capacity or room to grow? So an example is Linde. In 2012, they had taken a 5x growth in its capacities, and unfortunately what happened is that the steel cycle turned down and that capacity was underutilized. But the moment the China debacle started happening, China slowed down on and cracked down on polluting capacities, the Indian cycle looked up, and this company, which is practically a monopoly in this space, is really going to do well. So Linde is now experiencing capacity utilizations, and this should lead to the stock going up over a period of time. Another way to look at stocks is when the addressable size of the market is humongous, and the market cap of the stock is extremely tiny. So if we take the example of the FANG stocks, which is Facebook, Amazon, Airbnb, Netflix and Google, if you go back 5-10 years, you will see that their market cap was very insignificant. When you compare that with the global opportunity where they become global players today, that really created the situation for the stocks to rally. And today, when we consider the stocks to be expensive, one needs to understand that these are becoming global must-go platforms for doing your business. And going ahead, they're only expected to get bigger. So while they may look expensive, but the size of the opportunity compared to their market cap is very in a juicy spot. Another thing we have to understand is that multi-bagger stocks initially start out with low interest among investors. A classic example is JK Agritech. If you see this stock, it has outperformed, it has gone up nearly 4 times, and yet its market cap is tiny, and it virtually has very few or no institutional investors. And there are other compelling factors which make this stock a very lucrative market, a high growth company. Other factors which are important and essential is having high gross margins, high asset turnover, and sometimes structural changes in management and can also be a trigger for stocks to do well. So let's take the example of Kesoram Industries, a cement company and tire cord manufacturer. It was languishing for a very long time. The moment the Kumar Mangalam Birla came in at its helm, the entire business started turning around, and today we know that the stock is virtually a 3 to 4 bagger. Low price to book values is also another indicator which needs to be looked at. So Uflex, which is a star performer in the packaging industry, had some issues with the management of the company. Now, something that happened to the management in their personal capacity had a bearing on the stock. and it continued to remain, despite doing well, continued to have a very low price to its book value. So these kind of stocks eventually start rewarding shareholders as their full potential starts to bloom, and these are classic examples of characteristics that you should look at for buying stocks. Then stock prices in relation to net current asset value are also is also to be looked. Just like low price to book value, so you have a price stock price in relation to the net current asset value. Example is Pilani Investments. Pilani Investment is the holding company of the Birla Group and Kumar Mangal Birla Group. And if you just look at their stock businesses, Grasim, Ultratech, and what have you, and they're doing so well, so how do you expect Pilani Investments to lag? And when this stock is available at 0.25 or 0.3% of its total net asset value, then the stock is a screaming multi-bagger buy. Then one very important thing, just like your cyclical business cycles, you should also see where the stock is in the phase of its life cycle journey. Is it at the bottom of its rung and where no movement has started, or is it on a hockey stick curve, that is the growth phase, or is it maturing, or is the stock seen all these three stages? So despite being in a very juicy spot, if you are investing at the wrong phase of the cycle, then you may or may not get a multi-bagger. It is very important to invest in a multi-bagger stock during the sunrise and the initial growth phase of a stock to get going. And lastly, but not the least, is what I feel the single most important contributing factor for businesses going ahead. As we enter the realm of technology, and technology becomes omnipotent in our lives, it's going to create tremendous disruption around us. So disruption and exponential technologies, companies which focus on them are sure to do well. An example is Tata Elxsi, which is at the threshold of all the high growth technologies you have. Like we talk of self-driving vehicles, you talk of virtual reality, artificial intelligence, IoT. So the company is extremely well positioned to benefit from these. We will be seeing all these at a later stage. But what is more important, and that I strongly advocate, is that people read 5 years annual reports to get a better understanding of the company's visions, past performance, and future plans. This is your starting point when doing all the analysis. So I hope you have seen all these 20 factors which can lead to multi-bagger gains in the stock market. Now, I had spoken to you about the last point, disruption and exponential technologies. So this is at the root of the big stocks, global stocks, which have been doing well, what we call the FANG, which is Facebook, Amazon, Airbnb, Netflix, Google, Tencent, Alibaba. Do you know that Alibaba clocked $67 billion of sale on a single day? This happened very recently. And to understand this disruption and exponential technologies, we have to look at the 6 Ds, which I will enlist forth, which create a roadmap of rapid development that always leads to enormous upheaval and opportunity. This 6D terminology was coined by Peter Diamandis and Stephen Kotler in their book Bold. So what are these 6Ds? So first we start with digitization. Anything that can be digitized experiences exponential growth and then can be spread at the speed of the internet. Now, a digitized company, initially its growth is extremely deceptive because these companies are small. Their growth, as I have highlighted here, they have exponential trends. So 0.1 then becomes 0.2, which is actually doubling, but still very much under the radar. Then it becomes 0.4, 0.8. So it's doubling every time. And it becomes noticeable only when the stock has gone to 102.4% or 204% of its initial values. A classic case of a deceptive rally has been the bitcoins. Only of late it has been come to the notice of people. So what you need to do in these times of high growth and technology arena, you have to look at stocks which are fledgling stocks which are showing very rapid growth. What happens normally, we have a tendency to say that, oh, this stock is doubling because of a low base effect. Well, Bitcoin was 0.01 cents and today it is $18,000. Another thing is that the technology is disruptive. So what happens is existing product or services get disrupted as anything that is digitized outperforms in effectiveness and cost. Then once this disruption takes place, then we have the function of demonetization. So money is increasingly removed from the equation as the technology becomes cheaper to the point of being free. Software can be produced at infinitesimal cost compared to hardware, and software copies are virtually free. So we have the iPhone camera app, and you have the Contrasys Kodak, which shut down. It was a global conglomerate many years back, but today it is a sick company, practically shut down. Once the demonetization has happened, then we lead to dematerialization, where separate physical products are removed from the equation. So if you take your mobile and the number of apps that are in it, just think how many businesses it had rendered bust. Take the case of the pager, or you take the case of a copier, a fax machine, a telephone instrument. Virtually everything has been gone defunct. And lastly, once dematerialization has happened, then comes the democratization. So once digitized, more people can have access to it. And what happens is that you have got a simple technology, a cheap technology being available at the hands of billions of consumers. Well, I have benefited from this. So you guys are seeing this webinar purely because I used WhatsApp and the power of WhatsApp to spread the message about this webinar. So what started out as a simple idea just 15 days back has today traveled across the boundaries of India, and practically every sub-broker, chartered accountant, and educational institution has it on their mobile phone. I was really surprised the pace and speed with which these things have traveled. So this disruption and exponential technologies are going to be the single most factor that one should look at, apart from what we have seen earlier. Now, before we going on to take the case studies of analysis, I wanted to introduce you to a master course on picking multi-bagger stocks that I was planning to start. So this is an initiative that I am taking on my own, and anyone who is interested can click the link which is down in the description page, and you can submit your essentials like your mobile number, email ID, and your name, and then we can have a one-on-one correspondence to that. So this course is going to be the one of its kind ever that has happened so far. So we are going to have this course in 4 modules. Module 1 will be 70 hours of exhaustive training on fundamental analysis and valuation. This will be followed by 1 month real-time analysis of a stock idea that is a potential multi-bagger. Once these things are done, we will run a boot camp for a period of a week on how to inculcate personal discipline to buy multi-bagger stocks. Buying multi-bagger stocks, holding on to them is not a very simple thing. It needs a lot of behavioral change, and we will go through the entire process of the human element on how to hold multi-baggers, move with them, and when to buy them and when to sell them, and how to trade the precarious times when stocks dive deep, when the corrections are deep. It requires guts of steel to hold on to a stock, but we are going to replace that by focusing on cold calculated analysis and putting that at the fore rather than our emotions of anxiety and panic to emerge winner. Finally, we are going to have a fortnight training on identifying future exponential business stock ideas using the 6D principles. Here we will bring to light understanding on the emerging disruptive business opportunities, then networking to identify businesses in these spaces, then evaluating these emerging high growth businesses for viability, growth, market dominance, and sustainability, and early stage investment in these business opportunities will also be discussed. So, this is an entirely comprehensive course which is not just focused on analyzing a stock to buy and sell, but it is a comprehensive system for picking stocks that can be real wealth creators and make a vast difference to your life. So let's take a look at some of the stocks that I have as head of research researched and which have turned out to multi-baggers, and let's correlate them with the characteristics that we saw earlier. So the first stock obviously is Maruti Suzuki India Limited. Now people will say, well, you know, this is no big deal. But in 2012, this stock presented us with a very lucrative opportunity. There was an exceptional circumstance of the factory lockout between the union and the management, and this had led to the stock tanking almost 40% from its highs of 1600. This is when we had put out a buy, and we have seen the company capitalize on the strong brand and market leadership. It has, from a small car, it has graduated into taking on the likes of the Hondas, the Volvos, and the global players to reign supreme in the Indian market. This they have done through a strategy of proactive launches, keeping the margin sustainable, having a terrific distribution network, and a super spare part reliability business. This was supported by a strong technological backing of Suzuki, and they have focused on continuous efficiency improvisation through increasing localization of the products. And what's more, it has kept investors rewarded by heaping continuous dividends. So if you notice that the stock turnover has doubled from 2011 to 2018, during this time is PAT has gone up more than threefold, and its debt, which was at a high in 2014, has practically come to very halved or to one fourth of that during the same period. And over this time, its ROE and ROCE, which are shareholder return ratios, have grown superbly, and in line with that, the CMP or the market cap of the company and its P have also been sharply re-rated. Then we come to look at a company called Dalmia Bharat, cement company with very high aspirations. If you see in March 12, its CMP was a meager 143 rupees, and then it had fallen sharply in March 13 to 77 rupees. But this company went on to put up a capacity many times its existing size to become the fourth largest cement country in the world, in India. And what's more is that they not only raked up capacities, but their capacities were strategically located in high growth markets of East, and with a new leadership at the helm. So a leader was brought in from a peer company, Shree Cement, which had erstwhile performed very well. And the change in the leadership at the helm, together along with the aspirations of the management, continued process efficiency and low market cap to the potential business size, clearly led to the re-rating of the stock. And today this stock is trading at 3300 rupees. From 77 to 3300 is a mind-boggling return. Emami started out as like a fledgling player in the FMCG business, but the moment the stock got listed, we saw a sharp drawdown in debt. Then it went about launching key products in fast-growing categories. It had niche offerings, used celebrities as brand ambassadors, and focused on high margin businesses. So if you notice that although the revenue of the company had just trebled over the period of 6 years from 400 to 1200 crores, by no means a small achievement. You'll notice that its PAT has gone up almost 6 times. And this was possible due to paring down of the debt, improvement of the return ratios, and this rewarded shareholders who bought the stock. So if you had bought this stock at 269 when we had recommended it, today you would be sitting on a fat 4-bagger return. Also, if you notice, the PE of the stock has doubled. So not only has the EPS moved up, value has also been created. Now let's look at some of the stocks where we believe that there is still continuous multi-bagger opportunities being present. And one of these stocks is Arvind Limited. Well, I had put a buy on this stock at around 34 rupees in March 11, and today it's already at more than a 10-bagger at 400 odd levels. However, we believe that this stock will continue to be, sustain and remain a multi-bagger because of the market potential that is there. So Indian textile industry is huge and gargantuan, and despite that, the overall branded business is still a very small portion of the overall textile market. So Arvind, with a market leader with 20 brands to its 20 brand portfolio, is very, very juicily placed, optimally placed to milk this market and grow. We can compare this to Gap in the 90s when it turned into a huge business during the early 21st century, sorry. So along with this, brand also has an extensive distribution network which will ensure that the company does well. So this is another stock which we believe that if one were to hold, will continue to remain a multi-bagger over the next 4 to 5 years. Manpasand Beverages, a fairly unknown name, and they took advantage of the fast changing taste of Indian consumers for aerated drinks. So aerated drinks started becoming a hell hazard. This company quickly moved into the fruit drinks market, and they capitalized on the Indian penchant for mango drinks, and they launched their brand Slice. Not only did their brand do well, they also supported this with very strong product distribution. They nurtured the brand well, and this micro cap stock, when you compare it to the business potential, caught our eye, and today it has moved from levels of 200 odd to now be around 350 odd levels. We expect this stock to continue to do well as the market moves. Another idea where we latched onto very early was Edelweiss Financial Services. So this was a fledgling company quoting at sub 40 levels not very long ago. However, if one were to look at its businesses, it's remarkable that a company with such prudent financial planning could be available at such low levels. We identified this stock when it was around 80 rupees, and the trigger for this was the inside buying by the management, which alerted us to the possibility that this stock would start moving. So it has got seven verticals which are all high growth areas having very high NIM margins, and some of the new businesses which is entered into it is, these are all potential high turnover and low asset value businesses, and the strong branding and its research focused business should help the company to achieve high credit growth and expand its wealth management business along with the asset management to emerge a true multi-bagger. This stock over the last 1.5 years has moved up almost 3 times and is all set to grow by leaps and bounds in the coming few years. Now let's look at some emerging multi-baggers. We've spoken to you about Uflex earlier. So this company's DNA is that of a technological innovator and market leader. It is a pity that the stock has not done well for so many years, and that is what provided with an opportunity to enter the stock. It has a backward integrated re-engineering marvel. They re-engineer all their processes, which are all done in-house, and they have backward integration into virtual every element of their businesses. So they capture the entire value stream of their vertical. Recently, they have forayed into the non-disruptive market of aseptic packaging. Now, there was only one player for these many years, and that was Tetra Laval. And what has happened now is that with Uflex coming into this business, it is a duopoly market. Not only is the business capital intensive, but also you need technological excellence to build this kind of a business, and this dual combination is a strong moat for this company. And purely being the second player, what is happening is that the FMCG companies would not want to keep all their eggs in one basket with Tetra Laval, and so purely on a 80-20 principle, 20% of their business is being given to Uflex. And the Uflex management has been very smart to use this 80-20 principle, and they've set up packaging capacity in aseptic, which equates to 20% of the existing demand. So on the day one when they start out with this business, they are operating at potential full capacity. So with their entire asset turns locked in, the company will soon be going in for a capex of doubling capacity even before their business has started running on stream. So this low PE at 140, when we identified this stock and we came out with a report around 175, was a significant opportunity for us, and we believe that this stock over the next 3 years should do very well. Another business where only diehards survive in the Amazon jungle of education is Z Learning. So Z Learning is promoted by the SL group, and they really know how to run their business well, be it packaging, be it TV media business, or even the publishing business. They have perfected a model which is got very low assets, highly scalable business with franchise opportunities and huge sustainability, because education in India is one of the factors which is most dearest to the population at large. So we will ensure that as 50% of India is under 35 years of age, education will be a high growth industry, and hence it has a huge future potential. And this is a lone survivor in an industry which has seen continuous debacle. And by virtue of it being the lone survival, it will be the case of winner takes it all. So not only are they in the business of K-12, but also into the play school segment. And both these businesses are run on a franchise model, ensuring high ROCEs. The growth opportunities in similar high asset turnover business like HR training is also in which the company has recently set foot, and this should be another vertical which should fire the business of the company. Its franchise model ensures that the business continues to earn high cash flows and has low asset requirements. In fact, by 2020 this company will be generating 100 crores of cash flow, and with a market cap of 1500 crores, it's an enviable 15 times cash EPS. And sooner or later the market will take fancy to this stock. Fitness. Well, if you look at the papers, all you notice is the number of people who are dying of diabetes, suffering from cardiology and other lifestyle related problems, and hence fitness is going to be the vertical of the future. And Talwalkar's coming into an unpenetrated fitness industry is only saddled with huge opportunity. It is a market leader which is 2x the nearest peer in terms of number of centers. It has a vibrant growth outlook with a very sound strategy to expand and transform into a wellness brand. It is eyeing overseas opportunities to tap the global market. And recent business restructuring by demerging its gym business is going to ensure that the high growth 25% CAGR business with a low teen multiple will see to it that it expands. So this is a potential multi-bagger stock which could play out very fast over the next couple of years once the demerger of the businesses gets regulatory approval. And last but not the least, we have Sanghi Industries Limited. So this is a very interesting company. It is set up in Kutch and Gujarat, which was a surplus state and supplying to all the neighboring states, has slowly become a deficit state. Secondly, it has got into the sea route of shipping. So it is accessing markets right up till Kerala. Also, it is taking capacity expansion. It's not capital expansion, it is capacity expansion. And this capacity expansion is going to double. And its low valuation when we initiated coverage on this stock, with the potential of the market and its cost efficient leadership in terms of freight or maybe cost of production or even power, has landed the company in a sweet spot. In fact, all the forces of demand, supply, and balance sheet restructuring have colluded together to create a very enviable situation wherein the stock over the next 5 to 7 years will definitely turn out to be a multi-bagger. And before, although we said Tata Elxsi were the last of the ones, let's look at Tata Elxsi because it is the perfect candidate of the potential 60 Marvel. A niche play in the high growth automotive technology space, automation, internet TV, AR, autonomous car technology, and IoT. And it has considerable pricing power with very high margins. And this is all a heady concoction for a stock of the future. So, could this be India's answer to the fangs of the world? Only time will tell, and my money is on this. So that's all from my side. And friends, thank you for watching this webinar. And whatever questions you have, you may leave it in the chat box and we will get back to you with the same in the chat itself. Or you may connect with me on WhatsApp. My number is 97308363363. Or you can email me on bolinchka.vinit@gmail.com. You can see both the telephone and my email numbers being highlighted at the bottom of the presentation.